Robinhood is suddenly changing the game of finance, and their recent announcement of benefits from Robinhood Gold, which go from everything from a credit card to bonuses just for depositing money into Robinhood, could really change the way that we look at finance. And the reason that Robinhood is so interesting to me is this is a digital finance platform that can think of things very differently than traditional banks. And that's what's ultimately potentially very disruptive for the company. They don't have to play by the rules that everybody else plays by. And that seems to be exactly what they're doing with Robinhood Gold. So I want to dig into exactly what they announced and what the impact could be. I think this could be a major game changer for digital finance. I think Robinhood could be a beneficiary. And I think SoFi could be another beneficiary as well. It's another stock that I am keeping my eye on. Haven't added to my portfolio yet, but might in the near future. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's go to exactly what Robinhood announced yesterday. This is the overview of Robinhood Gold. This is a $5 per month service, so a small membership fee. But they say take your money to the next level with our membership program featuring the best value and most powerful investing tools. And before we get into some of the details, I want to talk about the overall strategy. The strategy for Robinhood was really to get into the finance market by being this trading platform. And now they want to be the place where you have all of your assets. So where you do your stock trading, where you have your retirement accounts, your banking, your checking, your credit cards, that's how they ultimately make money, is by having all of those assets under one roof. It's kind of a big bank philosophy, but with digital tools. And so that's the framing, is that they want to just have more assets and they're not necessarily concerned about making money on any specific one. The first thing is the 5% APY for cash that you have in your account. So that's a very good interest rate. There are other companies that offer really high interest rates, but this is one of the better ones out there. National average, they say, is 0.6%. That's probably true for some of the traditional banks who are trying to do the arbitrage between the rate that they pay depositors and what they have out in loans, because a lot of them took out loans that are underwater because they have very low interest rates. The second thing, and this is what made a lot of waves today, was the 3% cashback Robinhood Gold card. Now, this is going to be a members only card, but you get 3% cashback, which is the biggest number that I've ever seen on a consistent basis, and actually means that they're losing money on every transaction. This is a very different way to go about issuing a credit card, but it potentially makes sense for Robinhood because Robinhood makes money in other ways than just on these transactions. So what a typical bank will do is they'll give you 1.5% back, and they'll actually make a little bit of a profit on each transaction that you make. Then they'll also make money if you hold a balance and you have to pay 10, 15, 20% on that balance. So there's multiple ways for a bank to make money on credit cards. That's why they love credit cards so much. What Robinhood is saying is we're willing to lose money on that initial transaction to attract customers, and then we're going to make money in one of two ways. The first way is maybe you hold a bit of a balance and you're going to pay interest on that balance. We're going to make money off of that. The second way that they're going to make money is if you're the type of person like I am, like I would recommend for everybody, to pay off your credit card each month. But then they're hoping that you're going to use Robinhood for your brokerage account, for your banking, for all of these other products that we're talking about. So again, they're trying to attract assets to the ecosystem. Give up profits now for profits later. And that's, I think, the strategy. That's why this is so interesting. The other thing that they're doing along these same lines is a boost for every deposit. So just a 1% boost every time you deposit a paycheck, they'll give you an extra 1%. Again, pretty compelling way to attract assets. 3% IRA matching, and then instant deposits as well. So all of these benefits are really a way for Robinhood to attract customers. It wants to move beyond just being a trading platform to now being a full financial services company. This is very similar to what SoFi is doing. So that's the broader vision, and I think this is a really compelling way to get there. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, this is a similar strategy to what SoFi is using, where its Trojan horse into the financial services market was personal loans and student loans. They were offering something that the traditional market just doesn't typically want to do. Robinhood came in as a trading platform. But what both of them want to do is become more of a financial services company where you're going to have all of your assets on their platform the way that you might with a traditional bank like JP Morgan or Wells Fargo. That gives them more and more opportunities to make money off of what you're doing. Whether SoFi has moved into home loans, they've moved into being a brokerage and IPOs. So both of these companies are kind of playing a similar game to try to get into the digital finance market. And I think they're taking really compelling paths because these are the kind of offerings that a lot of the traditional banks can't do. One of the problems with commercial banks today is that they have a lot of debt where they were trying to generate yield when interest rates were much lower. So they bought treasuries that paid a 2% interest rate. And that was great when they were paying depositors nothing to have their money on the bank. They could collect that 2% interest. But now as interest rates have risen, depositors are saying, hey, why aren't we getting 4 or 5%? I'm going to move my money to Robinhood or SoFi. That pulls money out of those banks. And now they suddenly have to liquidate these assets that are less valuable. That's how you get the run on a bank. That's the risk for a bank long term. But that's not the same risk that Robinhood and SoFi are taking because they're not taking that same loan risk. They're not a traditional bank. They're a fintech company. They're what you interact with as a customer. They're where you deposit their money. They're where you deposit your money, but they're not taking the same financial risks from loans from a loan perspective. So I think this is really interesting for Robinhood. Shares were up slightly on Wednesday, but they've been on a really nice run lately. Shares have about doubled since the start of the year. Now, they're still pretty expensive because Robinhood is not profitable, at least on a full year basis, but forward PE ratio is 77 for them. If you look at SoFi as another company in this space, their forward PE ratio is 103. So both pretty expensive, but what you're doing is you're looking for them to grow their deposit base, the number of products that they're selling to customers, have more and more people in that ecosystem. And that's how they ultimately generate value, is by providing more and more products to those customers, maybe even charging a little bit higher fees for something like gold over time. But there are plenty of ways for these companies to make money. Banks have done this over years. You adjust, they make money on margin, they can start making money on loans. There's plenty of, so I think this is ultimately really disruptive to the banking industry. And that's why this is so important for Robinhood. What I'm thinking about is potentially adding a basket of Robinhood and SoFi to my portfolio. Like I said, neither company is one that I own right now, but what they're doing to disrupt traditional banking, I think is really compelling. There's no reason that we shouldn't be moving to digital banking overall and move away from the way that traditional banks have worked on Wall Street. And I love that disruptive nature of both of these companies. So what do you think about Robinhood's announcement? Do you think it's the kind of thing that you're going to look at as a customer? Does it compel you as an investor? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.